So here we are, Megan.sisk.aller, Nicole Rueth. We're here on a Thursday, kind of weird, but we're going to be doing this in June and July. So just as a reminder, Megan sent out the link to sign up for all of the Thursdays in June, and then she'll be sending out another one in July. Come August, we'll move back to Fridays. Swim practice will be over and we'll be back to our regular schedule. So I know that some people have agent meetings on Thursdays. You know what? Catch us on recording. This is all on live on Facebook. And of course, Megan sends out the link and we have it in our Facebook Agent Ignite group. So done with announcements. Let's talk about our quote and let's get started with what's happening, because this market is in transition. It's officially in transition. Some of the numbers are surprising and other of the numbers are right in line with where you think the market is going. So I've got a quote, which I think Megan and I really love, the idea of being energetic, positive, forward thinking, and proactive for our clients in a time where the news cycles are going to go negative, because negative sells. It just does. And in times of transition, it's really easy to go there. So here's my simple quote for today. Be so positive that negative people don't want to be near you. Literally put up a force field. Don't let them in. Stay positive. There's so much opportunity in this kind of market because transition will scare some people away, allowing your buyers to get in, your buyers who are Govy buyers, your buyers who maybe are using down payment assistance, your buyers that are using renovation loans. This is the time during transitions to get them under contract. So Megan, what is going on with the real estate market?
Yeah, so I just went through and trended everything yesterday for you. So the data is current as of Tuesday this week. So that encompasses Memorial Day weekend. And as you know, Memorial Day weekend kicks off our summer here in Colorado. And people are out there. They're out camping. They're out going to the pool opening. They're going to barbecues. We're an outdoor lifestyle community. And so a lot of people ended up taking that time off. So if you had buyers that were available to go out and look during that time, they found themselves in a significantly less competitive market environment. I'll go over exactly how much numbers dropped over Memorial Day weekend, and what I want you to do is to remember this is going to happen again over Independence Day weekend, because it will be a 3-day weekend again. So keep in mind that we have another transition point that will be coming up with more buyer opportunity as we get into those weeks. I also ended up seeing there were a lot of price reductions this last week for properties going under contract. So we are in a market that's in transition. We're not looking at the same market that we were back in January and February. We're now looking at our transition period where we're transitioning into the summer months. And typically this type of transition doesn't happen until after 4th of July weekend. This year it happened early, and I think that that's due to buyer affordability issues, where buyers are getting a little bit more sticker shock with interest rates the way that they are versus where they were at the beginning of the year. And then also it's buyer fatigue. Buyer fatigue set in earlier this year because our market was so tumultuous during January, February, and the beginning of March. Now, with a lot of that sticker shock knocking a lot of buyers out of the marketplace, now is the time to get them back into the market because more inventory is coming online. And with more inventory coming online, they have more choices and more negotiating power as they have more choices come online. We're likely to continue to see more choices come online up until about September. Then in September, we end up seeing the market pull back and sellers withdraw from the market in favor of listing in the spring months again. So keep in mind, there's a lot of buyer opportunity that's coming up as we go into the next couple of months here, with buyers getting a chance to have something to get under contract. Now, this report, again, is a little bit different than other reports that you may get out there. There's a wonderful DMAR report that will be published tomorrow. I highly encourage that you take a look at that. This report is different than that one in the sense that I only track the 7 Metro Denver counties and not the 11 Metro Denver counties. I'm still only using showing time data because I can't get any data out of Broker Bay yet. When I look at the number of listings that are set up for Broker Bay, it looks like it's about 15%. So there could be a variable of about 15% in terms of showing. So add 1 showing to the numbers that I'm sharing with you, and that may change some of the numbers that we look at here. But
hey, Megan, right out of the gate, we do have a question. You might go through this in your slides, but Arminio is asking, do you know what price points saw the most price reductions?
Yes, so at the higher end of price reductions, we ended up seeing larger and more frequent price reductions for homes that were over $1 million. Yeah. It ended up being roughly 25% of what went under contract over Memorial weekend. So again, here's our typical trend where we end up seeing that we see a cooling trend that happens in early July and late July, but this year is different. In 2022, when I look at this on a weekly basis, you can see that the cooling trend really started back here in April. That last week in April, right around Easter time, we ended up seeing the market start to cool as we checked the inflow and the outflow of new listing counts. We ended up seeing that there was a percent of balance ended up changing, as well as the rate of showings per property and how many price reductions were happening throughout the marketplace. There's also been a shift in the paradigm of how price reductions are taking place. It's changed based on usually what I see when there are price reductions that start flowing through the market is usually I see more widespread price reductions at smaller amounts. I'm seeing more widespread price reductions at higher amounts than what I would typically see. And so price reductions are definitely a thing that are flying around in the market right now. Based on data from last week, you can see the transition going from a non-holiday weekend into a holiday weekend, where we went from 0.5 months worth of inventory up to 0.7 months worth of inventory. And again, that's nowhere close to a market imbalance where we would expect to see about a 6-month supply of inventory. We're still sitting at only 0.7 of a month supply of inventory. What I expect to see is the buyer pool will regenerate over this next weekend and will pop back down to probably 0.6 or 0.5 months worth of inventory going ahead into these next couple of weekends. Coming soon's dropped way down. There are fewer people that list over holiday weekends. We only had 168 total coming soon listings come onto the market, and that declined week over week by about 25.7%. Our average daily active count held relatively even. In transitioning from doing our webinars on Fridays to Thursdays, now I'm pulling the data on Wednesday. Wednesday is not the fattest day for listings. It's typically on a Thursday that we see the fattest day with listings. So there's going to be a little bit of a change or a shift in the next coming weeks over how that number reports. But our average daily active count was 3,566. And you can see how much that is up, this blue line, from where we were back here in January and February, where we only had about 1,000 active listings available on the marketplace. So we've got roughly 3 times the amount of inventory now that we did back in January and February. Our new listing count ended up declining. Again, that's not uncommon over these 3-day holiday weekends. It was down by 35.7%. Back on markets, we had 225 units come back on market. About 40% of those were in a pending status, so that keeps our fallout rate for contracts right around about 8 or 9% of our units are falling apart and then coming back on the market. Expired listings fell week over week, as did withdrawn listings. Pending transactions, again, speaking to what happens over holiday weekends, pending transactions were down by about 30%, which is why I don't recommend that you list over these 3-day holiday weekends, because the rate of showings and the rate of pending transactions goes down very drastically. People are outside enjoying barbecues, going camping, going to family gatherings, and they're not out looking at homes over these holiday weekends. This signals the end of also graduation season for most school districts. And so people are just getting through all of their holiday parties. Closed transactions fell by 7.8% week over week. We saw an interesting trend this year where we ended up seeing a lot of people push their closings earlier in the month to try and get those done so that they could move in over Memorial Weekend. So fewer closed transactions, even though this accounts for month end, the last Friday of the month, and the last day of the week, the last day of the month being Tuesday, the 31st. We ended up seeing fewer closed transactions over this week in favor of people pushing those earlier. The odds of selling, again, this speaks to why we don't list over holiday weekends, dropped down to 70.9%. This has been slowly declining since we saw Super Bowl weekend. It's been declining by about 1 or 2% over each weekend. And I've had a lot of questions from people saying, well, should I wait and list my property in September when things even out, or should I go ahead and list now? The truth of the matter is that there are more units going under contract now than there will be in September and October. So your pool of potential buyers is larger now than if you choose to wait until September or October. It's true that prices stabilize, but prices are still going to be higher now than if you choose to wait until September or October. This is a blip for the holiday weekend where the odds of selling decline by about 5%. Going into the next couple of weeks, I end up expecting to see that number jump back up ever so slightly. We'll probably land at 73 or 74% odds of selling as we go into the next week. Now that's down from where we were week over week by 4.4%. And this number is also down from where we were 1 year ago. Last year, we had an extended selling season since we were coming out of COVID. And so this year, our market ended early, and it didn't end early. It started to taper earlier back over Easter weekend this year. We're still nowhere close to a market imbalance, even with the shift of having fewer buyers go under contract. We're sitting at 12.4% of the inventory that we require to offset demand. So we're not in danger of a bubble bursting at this point. Based off of what went under contract this last weekend, we would need to have about 30,000 active listings in our market, whereas we only had 3,566. Now, again, in order for a market to crash, we have to have three conditions that exist. We need to have some sort of economic widespread hardship that causes a severe loss of jobs or unemployment to go up drastically. We need to have a lack of equity in our market, and that doesn't exist. We've had near double-digit appreciation going on for about 10 years now in Metro Denver. So if a homeowner finds themselves in some level of distress, they're able to list their home quickly for sale, get it under contract, and walk away with that equity, which wasn't a choice that we had back in 2008 through 2012. And plus, we need to be oversupplied with homes, and that's what this graph shows, is that we are vastly undersupplied with homes, so there's no danger of having a market crash. There is a shift that's happening, and you definitely need to start setting those expectations with your sellers that you may not be under contract in the first weekend anymore. It may take 2 or 3 weekends to go under contract, and it may lengthen the timeout that you need to make a price reduction, where you may not be making a price reduction in week number 1 or week number 2, but waiting until week number 3 to make that price reduction. Based off of the number of showings that happened last week, only 3.4 shows per property for a new listing that went up over Memorial Weekend. So again, a huge decline in the rate of showings for Memorial Weekend. It was down by 33.8%. Total showings overall were down by 33.2%, and that was down from 1 year ago. 1 year ago, again, coming out of COVID, we had a much more active Memorial Weekend. This weekend wasn't as active as what we would typically see. It falls more in line with what we've seen from 2013 up until about 2020, where we had a less active Memorial Weekend, where people really take the time to enjoy those 3-day holiday weekends. So again, heed my warning. If you have a listing that's coming up as you go into Independence Day weekend, get listed the weekend before or the weekend after. I would stress the weekend before if you have Independence Day weekend coming up, or you have a listing coming to market, to get that listing to market sooner rather than later, because the trend shows that our buyer pool continues to deteriorate throughout the summer months. Now, again, we add in broker bay showings, I would tack on maybe 1 or 2 extra showings. So we're maybe looking at about 4 or 5 shows per property. So if you put up a new listing this last weekend and you didn't get 3 showings on it, that means that you might not be in the sweet spot in your marketplace. Strike 2 would be if you've had 11 total showings and no offers on that property, then you might not be in the sweet spot in your market. Now, again, if we're looking at getting about 3.4 or 4 shows per week, and we're getting 11 shows per property or 11 showings to go under contract, that may mean that it could take 2 or 3 weekends to go under contract. So we have to really lengthen out the time before you make those price reductions in our market. It takes longer to try and get enough buyers through that house to really understand if you're in the sweet spot in the market or not. Now, based off of what happened last week, we ended up seeing that median days on market was 7. So half of the homes were under contract in 7 days or fewer. We've watched that number slowly trickle up over the last 2 weeks. We were at 5 the previous week, and now we're at 7. That number is likely to drop back down to about 5 or 6 as we go into the next couple of weeks here, heading into our first initial summer months. The rate of price reductions overall for all price ranges, I end up seeing that there are larger price reductions and more price reductions as we go into these 3-day holiday weekends. But based off of what went under contract last week, 1 out of every 5 homes ended up making a price reduction. And so that's up from where we were previously. Our decrease increased by about 4.6% just week over week. Historically, for the month of May, we end up seeing about 25% of homes reduce their price. So we're not too far off from what we would typically see in May. I see the chat window lighting up, and I see you're off mute. So that means we have some questions.
I did. Some of the questions I've been answering, just asking how they get copies, and I let them know we send them every time, and answering some information about appraisals. But Danielle asked a great question. You're talking about the holidays. What are your thoughts specifically on Father's Day? Because I know you've got a Hallmark.
So Father's Day, there's a difference between holiday weekends. There are Hallmark holidays where we don't really take the time off we don't take a day off of work versus 3-day or religious-based holiday weekends like Easter, Memorial Weekend, Independence Day weekend. Those are mostly 3-day holiday weekends, or Easter is a religious-based holiday. In those religious-based holiday weekends or 3-day weekends, we end up seeing about a 30 to a 40% decline in the rate of showings and pending transactions. versus Hallmark holidays where we end up celebrating that time, like Father's Day, Memorial Day, or not Memorial Day, Father's Day, Mother's Day, Valentine's Day, where we end up seeing about a 10% decline in the rate of showings that end up happening over those weekends. So it's not quite as drastic. If you're under $500,000, it's probably not going to make a blip of a difference if you choose to list over Father's Day weekend or not. But if you choose to, you might still have fewer showings that are happening, or you might find that you're going to have the bulk of your showings that are set on Thursday, Friday, and Saturday, and you won't have as many showings set on Sunday so that people can spend time with their fathers. Now, again, looking at those holiday weekends, it's not a bad idea if you have one of those Hallmark holidays to list your home on a Tuesday to get enough time for people to go through and look at those properties earlier in the week so that you're not hindered by that holiday weekend with Father's Day being on a Sunday. Were there any other questions? Okay, so again, 1 out of every 5 properties that went under contract last week made a price reduction, and that was a pretty steep increase of about 4.6% week over week. And based on 1 year ago, that's up 10.7%. So we're definitely feeling a market shift in play where people aren't able to get the same prices that they were getting back in January and February. Now, again, the difference is here that when I see an increase in the rate of price reductions, historically what I've seen is more widespread price reductions, but at smaller amounts while people chase the market down. They don't want to cut too deep initially. But what I'm seeing now is larger price reductions up front, where we're seeing a 5.2% price reduction off the top, or about $45,000 off of an average priced home in Metro Denver, which is around $800,000 now. So there's significant price reductions that are taking place in our market at this point. We're seeing larger price reductions happening sooner in the transaction to try and recoup the lost showings that they got over the first weekend or two that were on the market. Now, looking at the under $500,000 price point, we're looking at, again, that cooling trend that has really started to happen over Easter weekend. We're seeing fewer new listings or a more average daily active count coming into the market, more withdrawn and expired transactions. Our predictive month supply of inventory is up, as well as showings going down. We're seeing our rate of price reduction start to normalize, and it's becoming cooler as time goes on, where we're starting to see more price reductions. Now, month supply of inventory for our under $500,000 market hit an all-time low back here over Super Bowl weekend at 0.1 months worth of inventory, or essentially 3 days to sell out of the existing inventory. We now have 4 times the month supply of inventory in our market than what we saw back over Super Bowl weekend. We're sitting at 0.4 months worth of inventory at this point. So that means that at the current rate of sales in this market, that we're going to sell out of the existing inventory in about 12 or 13 days, which is a lot faster or a lot slower than what we saw back over in January and February. But historically, that number is still considered to be a very deep seller's market. Our average daily active count only went up by 1.9%. New listings going into Memorial weekend were down by 33.3%. So a lot of people chose to forego listing over Memorial weekend. Back on markets, we're about 83. So again, we're looking at about an 8 to a 9% fallout rate. Pending transactions were down 30%. So again, this market took quite a hit over Memorial weekend, where it was down by 30.1%. So keep that in mind as you go forward into July 4th weekend, where we'll see fewer of those units going under contract over that 3-day holiday weekend. The odds of selling declined by nearly 5% over this particular weekend, down to 79.2%. You can see the clear cooling trend for the odds of selling as we head deeper into the spring and summer months, but we haven't seen it taper off quite as much here as we do at higher price points, so 79.2% odds of selling. Again, the odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same month, projected forward for a 4-week period of time. And so again, during this month, it's about 79.2% odds of selling if you listed over Memorial weekend. In this market, we only had 6.8% of the inventory required to offset demand, even going into a holiday weekend, nowhere near close to a bubble that could be bursting. Looking at showings, we had 6.5 shows per property this week versus what we were looking at back over Super Bowl weekend. We had 51.4%. So we're down to roughly 10% of the number of shows per property now in this price range that we were back in the peak during January and February. When interest rates initially started to go up in our market, it acted as a catalyst in the market, and it pushed a lot of buyers off the fence early and forced them into the buyer pool early this year. And so we ended up seeing that there were a lot more buyers in our market early in January and February when our inventory was so low, which is why we had such strained multiple offer situations that were happening, going $100,000 over asking price. So again, we're down to 6.5 shows per property. We'll probably pop back up to 9 or 10 as we go into the next week. Based off of that data, we had 11.6 shows should yield you a contract. So looking at the shows per week being 6.5 and roughly 12 showings to yield a contract, it could take 2 weeks to go under contract had you listed over Memorial weekend rather than going under contract that first weekend. We had 5 median days on market. That's the first time that we've popped up to 5 median days on market in this price range since we were back here in November. And so again, popping back up to 5 median days on market, that number is likely to pop back down to 4 as we go into the next coming weeks. Price reductions were actually down in this price range. It was only 10.8%, or 1 out of 10 properties ended up making a price reduction in the under $500,000 market, with an average price reduction of about $21,000, or about 5% off the top for those particular price ranges. The $500,000 to $1 million price segment represents 60.2% of our overall properties in our Metro Denver area. So this is by far the largest segment of homes. Looking at what's happened, we've seen the cooling trend come through. Looking at May, we really saw the cooling trend set in that first week in May in this $500,000 to $1 million market. Looking at our month supply of inventory, we're sitting now at 0.8 months worth of inventory, which is up from the 0.2 months worth of inventory that we were looking at back in January and February. So again, we have roughly 4 times the amount of inventory in this market that we did back in the early parts of January and February in 2022. So our market has shifted. Looking at coming soons, they were down by 26% in light of the holiday weekend. We had a 1.6% increase in our average daily active count. New listings were down by 40%. Back on markets increased by about 3.5%, still looking at about 8 to 9% of a fallout rate. Expireds and withdrawns were down. Pending transactions were down over Memorial weekend by about 30.4%, and closed transactions were down by about 3.7%. The odds of selling only fell by 3.8% in this particular price range. We were looking at 70.3% odds of selling. I expect to see this number continue to cool as we go forward into the summer months based off of what we've seen historically in the past after we hit our peak. Again, our peak was really back over Super Bowl weekend where we saw the odds of selling soar up to about 88%. So we've lost about 18% odds of selling from where we were at our peak back in January and February. We had 13.5% of the inventory required to offset demand, so we're still very far from a market imbalance. We should have about 16,500 total homes available for sale in this market to get up to a market where we have a 6-month supply of inventory. In this market, showings dropped way down. As we go up in showings and price point, showings drop way down as we go into these holiday weekends because they're more likely to be headed to their secondary or mountain home over these 3-day long holiday weekends, or going camping because they have the means to do so. We ended up seeing that our odds of our shows per property dropped down to 3 shows per property. Based on what went under contract last week, there were about 10.3 showings to go under contract. So that may mean that it could take you 3 weeks to go under contract in order to get enough showings through that property in order to get something under contract. Median days on market popped up to 8, so we added 3 extra days to the market over Memorial weekend. Historically, we were looking at 4 or 5 median days on market over the last couple of weeks. I expect that number to pop back down as we go into the next couple of weeks, down to 4 or 5 median days on market headed into June. This market ended up seeing that 25.7% of all the homes that went under contract last week made a price reduction, or 1 out of every 4. So that's right in line with what we would typically see in the month of May, with about 25% of homes having to reduce their price. And the price reductions that we saw were about 4.9%, or about $37,000 was the average dollar amount off of the original list price. For the 1.5 to 1 to $1.5 million market, we're looking at about 7.6% of our overall inventory at this point. And the cooling trend really started to set in at the beginning of May, where we ended up starting to see more listings making their way to market and the number of shows per property start to drop drastically. In this market, we actually saw our average daily active count decline by about 3.6%. Coming soons were down by about 30%. New listings were down by 40%. Back on markets declined by about 13%. We're still looking at about an 8 or a 9% fallout rate. Pending transactions fell by about 30.8%. Usually I would expect that number to be higher in higher price ranges, but we only saw a 30% decline in the rate of pendings over Memorial Weekend. The odds of selling remained relatively, well, not flat. They went down by about 3.8%, but we were looking at about a 64.5% odds of selling. That number is likely to continue to decline as we get deeper into our summer months. So if you have listings, get them to market as soon as you can, rather than waiting for the market to continue to cool and affordability to continue to be dampened. We only have 11.8% of the inventory required to offset demand. We should be closer to about 3,100 homes available for sale, whereas we only have 375, so we're only sitting at 11.8% of a balanced market right now. Shows per property dropped down to 2.7 over Memorial Weekend. So if you put up a new listing over this weekend, only 2.7 shows per property. So again, if you had a new listing that went up, about 2.7 or 3 shows per property is what you should have seen. We're now looking at about 12.6 showings should yield an offer. So if you're getting about 3 shows per week and it takes 12.6 showings to go under contract, you could be looking at 4 weeks on market before you go under contract. It's really important that you guys start setting seller expectations that you might not be under contract in that first weekend, because it's taking much longer to get the number of showings through those properties. Median days on market popped up to 8, which is an increase week over week by double, where we were looking at 4 median days on market just the week before. The rate of price reductions in this market, and so Erminio, this goes back to your question, 25% of these units ended up reducing their price, so 1 out of every 4 were had a price reduction included based off of the data that went under contract last week. Price reductions were hefty. They were an average of 7.4%, or nearly $100,000 off of the asking price in order to get under contract. The $1.5 to $2 million price point, we'll go through this really quick because I've only got about 3 minutes left. I promised Nicole I'd take up my entire 30 minutes this time because I've been dropping off early lately, and so I'm going to take it out. But the cooling trend really started to settle in this time over Memorial Weekend. You can see all of those blue cells really start to creep in as inventory makes its way to market. Our average daily active count actually went down by 6.4%. New listings were down by about 50%. Expired listings were up 33%, withdrawn transactions down 25%. Pending transactions, again, at higher price points, we end up seeing those take a dip more so over holiday weekends, where we saw nearly a 40% decline in the number of units that went under contract over Memorial Weekend. Looking at the odds of selling, it dropped down to 53.8%, and we haven't seen a number that low since we were back here over Christmas. And so it's been a long time since we saw that sort of dip in the odds of selling. And again, I expect that number to pop back up as we go into the next weekend or so, but it probably won't reach up to 65.2% again. I'm thinking that number will probably come in at about 60% next weekend. We still only have 12.9% of the inventory required to offset demand. We should have had 2 showings on a new listing that you put up last weekend. And again, people are looking at roughly 12 showings to yield an offer. So if you're only getting 2 shows per week, and it takes 12 showings to get to a contract, that means that you could be on the market as long as 6 weeks before you get a contract in hand. 12 median days on market, so that number popped way back up. We were at 7.5 last week, so we saw a 60% increase in median days on market. That number is likely to come down as we go into the next weekend. This market also saw 25% of the units that went under contract made price reductions. The rate of price reductions was nearly $200,000 off of the original asking price, or an 8.9% price reduction. The $2 to $3 million market, again, listing as you get into June, we start to see that cooling pattern transition in as we start to see more of those new listings making their way to market. And so we start to see that cooling trend where we can't demand the same prices that we could if you had listed back in March or early April. Let's take a look and see there's a really active chat window going on over here.
Oh, I was muted. Yes, it was very active. Somebody did mention that Juneteenth now is a federal holiday, and it's on the Monday following Father's Day. Do you foresee that changing things?
It's a federal holiday, so we get the day off now for Juneteenth?
I know Fairway is closed.
Oh, wow.
My cell phone will be on, but I do know that Fairway is closed on Juneteenth.
I didn't know that. Yeah, you know, I don't know. This is our very first Juneteenth.
Very first one. Very first
so
one.
If it's a 3-day weekend, I would say that most people are probably going to be dropping out of the market. If that's coupled with Father's Day weekend as well, then I don't know that we're going to see the rate of showing activity that we would typically over a non-holiday weekend. And so I would expect to see a decline again as we go through Juneteenth if we're taking that Monday off as well.
Right. Also a question, does anyone know, and I think it's to the group, it's from Kate Featherston, does anyone know if what we're seeing in Denver is the same thing that they're experiencing in Colorado Springs? I know I personally don't have data to back that up, but if you want to.
Anecdotally, I've had people say this is the same thing that we're seeing. I just gave this presentation to a company that spans the Front Range, and they said they were seeing the same thing in Fort Collins and Colorado Springs. So it seems like it's kind of the same transition.
I think it's that level of intensity is high, right? The price points might be different, but the level of intensity is still high. And then the over market, you know, there was that news article that came out based on a survey that was done ranking the top 100 housing markets being overvalued. Joy is asking, I've had a couple of people ask me if our market is overvalued with supply and demand the way it is in Denver Metro. I don't believe so. However, with the Denver Post putting out the headlines, can you speak to that?
So I don't think it's overvalued. I think that this is a normal seasonal pattern that we go through, but it's had a transition that happened earlier coupled with higher interest rates. So we're likely to go into our cooling phase earlier this year and see our leveling out probably happen earlier this year as well. Now, this is something that we happen to transition to, and typically it happens in late July, August, and September, where we end up seeing a seasonal decay in pricing. And so again, we might just be seeing that transition happen earlier this year, but I don't think that homes are overpriced, but we are seeing somewhat of a different type of correction because it's in light of higher interest rates. But I don't think they're overvalued because, again, if you stay in that home for 6 months to a year, we're going to have another run up as we go through next spring, as we go into January, February, and March, as we start to see that traditional pickup. So I don't think that appreciation is going to stop. I think that it's going to slow down, which is something that we've all been asking for a long time. And so hopefully that's what we end up seeing, is that we start to see the rate of appreciation slow down so that we're not getting so overpaced in our house pricing.
I could not agree more. And interesting, you're talking about the fact that we are going to give back some of the extreme appreciation that we've seen this first half of next year. If we see this pickup again, and we see the seasonal pickup again, just naturally, on top of the fact of if it times with a recession or slowdown or drop in interest rates, we're going to accelerate that. And so we're only going to have more appreciation next spring. And so you don't want to be looking for a home or waiting for the perfect home. You want to be getting in front of that, be able to take advantage of the opportunity for continued appreciation.
Absolutely.
We were number 37 on that list, by the way, of the 100 top metros with our 21.9% appreciation. We were number 37. Boise,
oh gosh, I can't believe we were only number 37.
I know. We've actually pulled back. There's some metros that are still on fire. Boise made the number one on that one. I had that. I was going to show it, and then I was like, now it's already a thing. So here we go. I do have. So that article, I actually have I can send. I can get my voice back. I can put a link in the chat to the actual survey that was done, because Denver News, of course, you know, you have to have a subscription for, as well as several other websites that curate it. So I couldn't get there, but I did get back to the root site that did the survey. It's a university. All right, so I'm going to quickly jump into the presentation mode so that we can get started on the economic side of things, what's happening with all these numbers, right? You guys are seeing the transition. What does that mean? Why is it happening and staying relative, as well as talking about what are the opportunities for our buyers? I mean, Megan talked about it. I talked about it the Thursday before Memorial Day weekend. And interestingly enough, mortgage purchase applications are down, but my team worked off the charts. So we actually had higher mortgage purchase applications than we did any weekend year to date, and more contracts, just by doing the things that we know we need to do and by supporting our clients and talking about it. We have to be the loudspeaker for our buyers, because they're seeing all these negative headlines and they don't know when these windows of opportunities come, when we have a little more supply, when we have a little less demand, which means that maybe they could be the only offer going in. And yes, rates dipped 0.5% in the second half of May. So what opportunities did that give them? Opportunities to get under contract and get locked. So I'm going to share my screen. I have the ability. I know I do. I'm smarter than this. All right, here we go. All right. So as we get going, let's just jump into kind of really one of my highlights from this past weekend. Memorial Day weekend, we did the thing. We actually had 2 clients go under contract with renovation financing. And I bring this up because it ties into exactly what we're talking about. The buyers need to know when the opportunities present. It has been too long since we've been able to get a renovation loan under contract because they take longer. They just do, because we have to get the contractor bids and we have to get the appraisal as a to-be appraisal. But the win on renovation loans, you need to know, because there are homes that don't have a great layout, might have been not taken care of, might have any kind of delayed maintenance, or maybe they're just in a bad location. I can't fix that with a renovation loan, but you can fix a bad layout or you can fix outdatedness, right? You can do that with a renovation loan. You can do the appraisal and the loan based on the future value, not the current value, and you can roll it into the loan with as little as 3 to 5% down with a primary home, 10% down with a second home, and 20% down with an investment home. All of those possible renovations. So I wanted to bring that back up again because we did get to this weekend. Super excited, and thank you for the sellers that did list on a holiday weekend, because I get the fact that maybe you shouldn't have, but you did, and our buyers were able to jump in, get under contract, and make their dreams of home ownership come true. And we also did this through the things that we continue to do. I don't want to sit here and sell on the Rueth team because we've got a ton of advantages, but I do want you to know this is the time to communicate. If you need something to communicate with your buyer group, we have things you can communicate. You can communicate new programs that are coming out. You can communicate whether or not the interest rates are going up or down and closing that hole of opportunity or opening it up wider. You can communicate the fact that we can get a TBD approval with an 8 to 10 day closing or waive a loan availability. All of these things are opportunities to continue to open the door of conversation. Opening the door of conversation allows you to continue to get more business in the door, right? It all starts with the ability to have that conversation. So on to the economy. So interest rates were big conversation this month and this week. We continued to see interest rates go up the first half of May. In fact, they'd hit kind of a high on May 7th. And then since then, they started to go down. The last 2 weeks of May, we actually had a retreat of a 0.5 point in interest rates. We gave most of it back the last day of May and the first day of June. So that hole just closed up. Now, it doesn't mean that we're not going to see continued appreciation, that we're going to continue to see buyer opportunity. And then when it comes next year that the interest rates go down, we refinance. That's the opportunity that lending continues to give you. You're not locked into that rate, but you are locked into that purchase price. And that's something that's important. So the 30-year fixed rates did start to go back up again. I really want to point out here that the Freddie Mac rate sheet came out this morning. It comes out every Thursday, and it actually showed that interest rates went down 0.01. Really important to talk about the fact that that includes a 0.8% discount, which is almost a full point. The other surveys do not do that, and their survey is lagging. So not only did it come out today, it doesn't really have data from last Monday and the previous Friday, whereas some of these other surveys are more current, and they're asking that information on a daily basis.
We already have one question that popped up.
Yeah.
What would happen to the housing market if Russia were to declare war on the United States? I have friends in the government who said it's inevitable.
That is a bigger question than I could probably answer right now. I'd have to really chew on that, because obviously you're going to have a stall on consumer spending depending on how deep or wide that war goes. I mean, that's opening up. Megan, do you have thoughts on that?
I don't have a clue. I mean, on whose front are we going to be waging this war? Is it going to be on our fronts, or is it going to be on Russia's fronts, is what I'm concerned about. And what are the areas that would be most targeted if that was going to happen? And so I don't know. I don't even begin to know how to answer that question.
No, because I would certainly put my foot in my mouth if I did try, right? It's like, I can guess some things, but I'm not going to go there right now. But that's a great question. And it's certainly something to continue to think about. I have not heard that as of yet. All right, so the 10-year, which is most closely correlated, obviously, to the 30-year fix, and why the 30-year fix did some of the movements it did. Some of the 30-year fix reduction had to do with bringing the spread between the 10-year and the 30-year fix back in alignment. We were off by quite a bit. The historical average between the two is about 165 bips, which is 1.65%. That had increased to over 200 due to risk from lenders and due to increased costs from Fannie Mae and Freddie Mac. But we saw an incredibly volatile market yesterday. And with that, and why was it? And interestingly enough, it was on the manufacturing PMI numbers that came out early in the morning. And it created a lot of whirlwind around what was happening. We had two things actually that was happening yesterday. The manufacturing PMI came out, which is the Purchasing Manufacturers Index. And interestingly enough, I had showed this chart a month ago. It had come out, and a lot of these said slowing. So it was all growing. We're increasing, we're manufacturing more. This is based on manufacturing, and then you have transportation, and then you have consumer consumption. Those things impact inflation and impact the cost of everything. It's a measure of when we start going into a recession. It's really important to have your finger on the pulse of the PMI. When it starts slowing down, you'll start to see other things slow down, and we'll start to have these indicators raise the red flags, if you will, for the recession coming. Just last month, these were growing, but slower. Interesting turn this month where they're happening, and they're happening faster. The only two that are contracting is employment, which we know because we have so many open job positions, and imports, which makes total sense since China had just been locked down for so long. But this stirred the market because this tells the Fed that they can continue to raise the rate because the economy is still buzzing, right? We're not slowing down so much so that we're seeing the manufacturing index drop, which is a leading indicator that we're heading into the recession. So this gave them kind of the go ahead to continue to raise rates. The other thing that jumped the rates or jumped the 10-year yield yesterday was that the Fed just yesterday started their quantitative tightening. We've been talking a lot about quantitative easing, and then the Fed starts raising the Fed rate. And now officially, as of yesterday, they've started their quantitative tightening. Now that quantitative tightening is going to put pressure on the stock market, because what that does is quantitative tightening is basically a way to reduce the money that's floating around in the economy right now. They're going to sell off their assets. Other people are going to buy them, and they're going to reduce the liquidity. They're going to make the prices of bonds because of that go up, which is going to make them look sexier and move people over from the volatility that we're seeing in the stock market. So because they're messing with supply and demand, you would expect that interest rates are going to go up. But because they're attracting people from the stock market into the bond market, you would expect that to drop interest rates. So we're going to have an absolute tug of war with the quantitative tightening. And very infrequently is quantitative tightening used to control inflation. So we're going to have to watch this because we don't really have really strong historical standards by which to say, what is this quantitative tightening going to do for our interest rates and for our market? Initial jobless claims came out this morning, and they came out stronger. So they were actually continue to go down. They dropped 11,000. This is another recession red flag. We're watching for at what point do more people get laid off? At what point does the unemployment go back up? That is saying that the economy is slowing down. We're hanging on. Even with as many open job positions we have, people are laying off. And if they are laying off, they're getting another job right away. The initial jobless claims are down. The continued jobless claims, those people that get on and then stay on, is at a record low since 1969. So just continuing to talk about how strong this is. ADP payroll came out this morning. Tomorrow, we're going to have the unemployment number. Because of the ADP payroll coming out, although weaker than expected, showing some signs of slowing, but still positive, right? That's what we're seeing, that this is happening, but in a very slow trajectory, kind of our transition in the real estate market. Because the ADP number came out the way it did, because the expectations of the labor market, we're expecting unemployment to drop 0.1% from 3.6 to 3.5. So we'll continue to watch that. Again, it's just a measure of how slow is the economy happening, or how much is it slowing, right? Which is going to put us towards a position where the Fed can pull off of the gas, start to tap the brakes on how much they're using quantitative tightening and raising the Fed rate to control this inflation. But a lot of the inflation isn't temporary. A lot of the inflation is wage growth and housing growth, and those aren't going to give back like the price of gas at the gas station or the gallon of milk. And a lot of it has to do with what's happening in Russia and Ukraine and China. That's not going to unwind very quickly. So all of this going to talk about, and then of course, we'll see what the unemployment is tomorrow. It would be shocking if it was higher. We're expecting it to be the same or slightly lower. Meanwhile, consumer confidence has dropped. Now, this consumer confidence index really is focusing on how secure do people feel in their jobs. And the present situation index was driven solely by that perceived softening of the labor market conditions. Now, again, we just showed you the ADP came out, but it came out that less jobs were filled than expected. So is that slowing? And more importantly, with the small businesses. So small businesses are feeling that even quicker, which is really a telltale, or kind of like the bird in the cage, right? Or the bird in the canary in the coal mine. Canary in the coal mine, talking about the fact of, is this a leading indicator that small businesses are having a hard time hiring people and small businesses are first laying off because they're feeling the shifts faster than large businesses who can sustain this. But consumer confidence is down, yet retail sales is still continuing to stay strong. People are still spending, but mortgage purchase applications nationwide are down. They were actually down last weekend. You would expect most mortgage purchase applications at most lenders were down. We were up because of the conversations, because we were telling every buyer that they had a window, that they had an opportunity with lower interest rates, with a little bit less demand, especially given the holiday weekend. And yes, maybe a little bit less supply given the holiday weekend, but still more supply than they had seen. I mean, we had an incredible weekend of buyers going under contract, but overall nationwide, if people aren't communicating the opportunities that were available to those buyers and suggesting the creative solutions for getting them under contract, then it wasn't happening. Then those buyers are simply reading the headlines and staying put. So we saw the mortgage purchase applications were down, and they just hit the point at which they were December 2018. And if you remember, fall of 2018, we saw interest rates rise above 5%. And then 2019, we saw an appreciation of just over 2%. So as we're watching this, if they continue to go down, we would expect that inventory would continue to make itself available. Now, as of yet, this is not affecting pendings or closed. I pulled this off of Redfin, direct access to the MLS, talking about the comparison of this year to the previous years. Our pending sales continue to be strong. So do homes sold. And Megan has shown that number as far as how much we're actually selling, pending, and sales. Now, week over week and week to week, we might see some fluctuations in that. But if I'm looking year over year, we have an incredibly strong year in front of us. We cannot continue to compare it to 2020 and 2021. When comparing it to 2019, we have extremely strong sales and pending sales. Both of those, and in fact, in the DMAR market trends report tomorrow, we'll continue to see that month over month strength in both sales and pending sales. Now, year over year, it's slightly down, and home price growth, interestingly, is flattening out. It's starting to do the transition that Megan was talking about. So we'll see that as we release that market trends report tomorrow.
A quick question came up.
Yeah.
How many applications are you seeing drop out due to job loss or buyers dropping out of contract?
I don't have that number nationwide. I can say personally, we are seeing a few, very few. In my current pipeline, 2 people lost their jobs. So which is, you're talking about a pipeline of about 90. So then the percentages is pretty low. More people, once they get under contract, if they're paying more, we're seeing them get out due to inspection than anything else. Okay. All right. CoreLogic just put out their report a couple of days ago as well, showing the price appreciation. Now, know that CoreLogic is always delayed. These numbers are March data, and I know we want to be talking about May, because we're in June. So I get that. But thinking relative, when we were absolutely seeing a height in March as well, nationwide, we saw a record-breaking March. And this is not 2020 nor 2021. Of course, March 2020 is when everything started to shift, but not 2021, but 2022, when we're seeing this transition starting to happen. This is also when interest rates started to go up more considerably than even they did come starting in January. But this is the highest number nationwide that we had ever seen at 2.6. I want to show this on a chart. Calculated Risk blog puts together kind of every single dot plot of the month over month appreciation, not the year over year, the month over month appreciation, and how many months of inventory at that time. And you can see, obviously, there's a relationship between how much the price is going up and how much inventory is available. And as we see that increased month over month appreciation, we're seeing the months of inventory drop down, right? So interestingly enough, as we see this, and as you watch the DMAR Market Trends report tomorrow, we're starting to shift where we're giving back some of that appreciation. We're heading back towards flat, yet we still don't have 6 months of inventory, because ideally, if you were at a 0 month over month appreciation, you would be at a balanced market. You would be right at 6 months. We don't have that. Megan was showing that our months of inventory is measured in weeks, not in months right now. But this second half of the year is going to go through transition, which is why it is so important to have those conversations, both with your buyers and with your sellers, because the alternative is renting. I mean, ultimately, you can choose to sit on the sidelines and wait for something to happen and wait for the bubble to burst, which isn't going to happen because of those indicators we continue to talk about, or you can choose to jump in, purchase something today, looking forward to the opportunity of being able to refinance, start building the wealth that only real estate gives you. The alternative is renting. We just came out with a report from Apartment List this week as well. This report showed the year to date was already up 3.9% for 2022. If you look at the entire year for 2018, 2019, and 2020, the entire year, our shortened year to date is already more than that. It is starting to slow down as home prices will start to slow down. Those two correlate. In Denver, we're continuing to see that. Luckily, we're not Miami. Miami saw a 41% increase year over year. We're not that bad. We're sitting at closer to 13%. So we have dropped from the 15%. But if we look at the United States right now, we're on average at 15.3. Colorado is 14%. The Denver metro specifically is at 13% year over year, not year to date, but year over year. Our month over month was increased in up 1.2. Now this data is relevant. This data is all in May. This is making us number 54th in the top 100 metros, which is really good. Now, if you're interested, we were talking about Colorado Springs just a few minutes ago. If you're interested in other areas, right? So looking at this, Inglewood, I love Inglewood. My office is in Inglewood. Inglewood actually saw the fastest rent growth in the entire metro, hitting a 17.6% increase. We are seeing a ton of new build opportunities and rentals here in Inglewood right now, especially around the hospital. Parker has the most expensive rents, especially compared to the rest of Denver metro. So all of that interesting. So comparatively, Fort Collins is at 15.2% and Colorado Springs is at 10.9%. The rents are not going up as fast, but it is all relative. This kind of opportunity, as we continue to talk about understanding the market, understanding all the numbers that Megan is talking about, understanding what the Fed is doing, how it impacts our rates, what the quantitative tightening is doing to the market, how it's creating an edge for the stock market right now, how that might continue to influx money to the bonds, how initially the quantitative tightening might push up interest rates, but if we do see fear in the stock market, and that money come over to the safety of bonds with the higher prices, we might actually see some of those interest rates go down. Being in queue to this, noting when interest rates do dip and letting all of your buyers know when those windows of opportunity happen is a game changer. It absolutely changed the game for a lot of the agents that we work with because their buyers were ready to go, 100% ready to jump in on the opportunity that was Memorial Day weekend. So those are the things that we have to continue to watch, because this is the opportunity that it affords you. I had to update these numbers based on our continued price growth. This is our median price point right now in the Denver metro. Based on that price point, if I take a 5% down at 5.25% interest rate and look at the annual principal reduction, and I add up every single one of these years' principal reduction and the increase in pricing at 6%, which is the historical average that the Denver market continues to grow at. So if I take that 6%, this could mean the difference of $250,000 for your borrowers. You want to tell me who their favorite person on the planet's going to be 5 years from now when they have the opportunity? And this isn't even using the numbers that we saw in 2020, 2021. These are using historical numbers relative to the Denver market. In fact, I showed I wanted to include this chart because up until this past year, this number, if I average out all of the increases year over year, it's 6%. Of course, last year jumped that up and now it's 7.5. I didn't even want to use that number. I wanted to use the 6% because that's the consistent opportunity. That's the opportunity that says people continue to want to live here. People will continue to move here, purchase homes. And if they can't purchase, they'll rent. Rents will continue to go up. Really quickly, a couple things that you need to know going into the next weekend, holiday weekends or not. So the Fairway Cash Guarantee is starting to gain ground. We've won 9 deals already using the Fairway Cash Guarantee. If you don't know how this works, especially now that appraisals are not coming in at the extreme below where they had been 3 months ago, now we're starting to get to a point to where, honestly, I can't remember a single appraisal coming in low in May. So as I look for that, I am going to get the numbers, the official numbers on appraisals coming in low, and I'm going to get that out to everybody. But as we're looking at this, we have the opportunity to waive loan availability and help buyers get under contract with a cash guarantee. It's absolutely won us 9 deals already. The lease buyout program, we've got 12 agents that are already taking advantage of this, where we're doing a match, helping buyers get out of the rental lease and into their home ownership. Game changer. Don't sit and wait for that lease to expire, letting months go by of home price changes and opportunity for principal reduction, right? It's twofold. It's yes, it's appreciation, but you're paying 100% interest to that landlord when you're paying rent. And then we also have the refinance guarantee. We gave out 68 certificates this last month that if you buy with us in the next 24 months, if rents go down, or if, rates go down and you have the opportunity to refinance, we're going to give you $1,000 credit towards that for one reason, because I believe in home ownership. And if that's the reason why you're not doing it, then let's get in now and let's stand behind you and support you. Next big thing is officially on the calendar. I announced it last week. We'll start announcing speakers, but it is at the beautiful Omni Hotel at the Interlochen. Definitely a hotel that you want to stay at on February 2nd and 3rd. Please scratch out those dates and hold them for the next big thing. And with that, 2 minutes to spare. All right. Any questions or are we good?
No, we got everything. Everyone was just asking if we're going to be posting this someplace, and it's going to be on the Agent Ignite page for Nicole. It's on my personal social media page for Megan.sisk.aller, and I'll be emailing it out by 1 o'clock today so that everyone gets a copy of everything. It's always in my signature block. So if you ever miss a copy of it, just shoot me an email to maller@firstam.com, and I can always just send it to you because I just keep a copy of the recording in my signature block for you guys all the time. The reason why we do this is not only do we love stats and what's happening macroeconomically, it's because we want to help you be better agents for your buyers and sellers. And we certainly hope that if we're able to help you better advise your buyers and sellers, that we'll get a seat at our closing tables at Fairway Independent Mortgage or at First American Title. So please keep us in mind for your upcoming transactions, and we hope to see you soon at our closing tables. Other than that, I hope you guys have a great weekend. Thank you.
Happy Thursday.